Not every war begins with soldiers advancing or borders being crossed. Some wars begin quietly inside balance sheets, insurance contracts, and global clearing systems that most people never think about. Over the last 48 hours, while headlines have focused on missiles and military responses, something far more dangerous has unfolded beneath the surface. The real battlefield is not just physical territory, it is liquidity itself. Markets do not collapse because of explosions alone. They collapse when movement stops, when capital freezes, when money that is assumed to be mobile suddenly becomes trapped. This is not a future risk scenario. It is happening in real time, and the scale of exposure tied to the Middle East is far larger than most investors understand. What we are witnessing is not simply a regional conflict. It is the sudden paralysis of one of the most critical financial arteries in the global system. The consequences of that paralysis are already spreading far beyond the region, directly into Western equity markets, pension funds, and household savings accounts. This is the collapse nobody priced in. Like this video and hit subscribe button, as you are going to know about something you are completely unaware. The illusion of the untouchable Gulf. For more than 2 decades, global finance operated under a comforting assumption. The wealthy Gulf states, Dubai, Doha, and their surrounding financial hubs were believed to be immune from direct geopolitical disruption. They were marketed as insulated sanctuaries where capital could operate freely, safely, and profitably, regardless of regional instability. These hubs positioned themselves as bridges between East and West. They offered tax-free corporate environments, deep sovereign wealth partnerships, and regulatory frameworks designed to attract massive foreign capital. Wall Street embraced this narrative enthusiastically. American private equity firms poured hundreds of billions of dollars into luxury real estate, logistics infrastructure, ports, airlines, and regional banking systems. The assumption was simple. Money might move through unstable regions, but it would never be targeted directly. That assumption is now dead. Recent retaliatory strikes deliberately bypassed traditional military targets and struck the economic crown jewels of the region. This was not symbolic violence. It was financial warfare. And it shattered the illusion that Gulf capital hubs were untouchable. When liquidity becomes the target. The most dangerous feature of this escalation is not physical destruction alone. It is the deliberate targeting of financial flow. Missiles did not just land near desert outposts. They struck commercial centers, shipping ports, aviation infrastructure, and symbolic landmarks that underpin regional economic confidence. Verified footage shows smoke rising from luxury commercial districts and structural damage to buildings that drive tourism, commerce, and institutional investment confidence. But the visible damage is only a fraction of the problem. The true crisis is paralysis. Civilian airspace across the Gulf has been shut down. Some of the busiest passenger and cargo hubs on the planet are offline. Commercial flights cannot operate safely. Corporate personnel cannot travel. Cargo cannot move. At sea, the situation is worse. Maritime shipping insurance markets have effectively collapsed. Risk premiums for vessels entering the Persian Gulf have become uninsurable. Without insurance, ships cannot legally operate. This has frozen one of the most critical shipping corridors in global commerce. When air and sea shut down simultaneously, liquidity does not slow. It stops. Trapped capital and the private equity time bomb. Consider the structure of a modern American private equity firm. These institutions hold billions of dollars in illiquid overseas assets. They own commercial skyscrapers, luxury hospitality developments, logistics networks, and equity stakes in regional banks and infrastructure operators across the Gulf. These assets are not easily sold under normal conditions. Under wartime conditions, they become effectively frozen. Valuations collapse instantly as geopolitical risk premiums approach infinity. Buyers disappear. Markets cease to function. The most dangerous element is not mark-to-market losses. It is the inability to extract capital. Clearinghouses and banking networks are operating inside an active war zone. Liquidity cannot move safely. If an institution faces margin calls elsewhere, it cannot raise cash from its Gulf holdings. This is where contagion begins. To cover losses or meet obligations, institutions are forced to sell assets elsewhere, often domestic American equities and bonds. This forced selling drains liquidity from U.S. markets regardless of underlying corporate fundamentals. Retirement portfolios bleed not because companies failed, but because institutions are desperate for cash. This is the mathematical mechanism of financial contagion playing out in real time. The secondary market has vanished. One of the clearest signals of systemic stress is the collapse of secondary markets. Middle Eastern private equity stakes now face zero bids. Not low bids, no bids. No rational buyer is willing to step into an active war zone while missiles fly and insurance coverage evaporates. This creates a terrifying internal crisis for asset managers. Without market pricing, portfolios cannot be accurately valued. Pension funds are forced to write down investments. Funding ratios deteriorate. Emergency capital injections become necessary. These injections strain an already fragile domestic banking system. Regional banks, already exposed to commercial real estate stress, face additional pressure as private credit structures unravel. Shadow banking networks that relied on uninterrupted sovereign cash flows begin to crack. The Federal Reserve is watching this unfold with macroeconomic dread. The maritime insurance collapse. Most investors underestimate the power of insurance markets. Global trade does not move because ships exist. It moves because risk can be priced. That pricing is controlled by opaque but enormously powerful institutions, particularly maritime insurers based in London. When the Persian Gulf was designated an extreme conflict zone, standard shipping coverage was revoked overnight. War risk premiums replaced normal insurance at astronomical levels. For most operators, those costs are unpayable. Without insurance, container ships sit idle. Each trapped vessel represents millions of dollars in losses per day. Rerouting around Africa is financially devastating and time-consuming. Supply chains fracture instantly. The costs do not stay offshore, they are passed directly to consumers. Retailers raise prices simply to survive. Inflation surges not because of demand, but because movement has become prohibitively expensive. This insurance freeze destroys the fragile disinflation narrative Wall Street relied on. The energy shock no one can contain. Compounding the crisis is an unprecedented energy shock. The Strait of Hormuz, through which roughly 20% of global oil flows, is becoming militarily compromised. This is not theoretical, it is actively unfolding. Blocking this choke point guarantees a violent surge in energy prices. Analysts are no longer modeling mild fluctuations. Scenarios now include crude oil exceeding $200 per barrel. Natural gas supplies to Europe are trapped. Industrial manufacturing faces shutdowns. In the United States, diesel shortages threaten domestic logistics. Agriculture depends on petroleum-based fertilizers. When diesel costs explode, food prices multiply. This is how energy shocks metastasize into systemic inflation. The Federal Reserve is trapped. The end of dollar dominance. For decades, dollar hegemony was reinforced by petrodollar recycling. Oil was sold for dollars, which flowed back into U.S. treasuries. That trust is now evaporating. Foreign central banks see the vulnerability of dollar-denominated assets during conflict. They see financial systems weaponized. China is exploiting the vacuum, offering swap lines and settling energy transactions outside Western clearing systems. This is not a future threat, it is happening now. Declining dollar demand guarantees persistent inflation. Stagflation becomes the baseline reality. If this analysis helped you understand what is unfolding beneath the headlines, like the video to support independent research. Subscribe for continued data-driven macro breakdowns. And comment below how you are positioning for the most volatile decade in modern history. Stay informed. Stay defensive.